we're going to talk a little bit more about a real estate syndication. So what is a syndication? All right, it sounds like some criminal enterprise or something. But what it typically is it's an apartment building. It's an apartment complex, maybe. Okay. And you can't afford the whole stupid thing yourself. So you go into it with a bunch of other investors. Okay. Maybe it's 99 other investors. So there's 100 of you that bought this thing. And you hire a manager to manage it, and they go out and they buy the property, and they maybe fix it up some, and they, raise the rents on people, and they try to run it well. And 3 or 4 or 5 years later, they sell the property. In the meantime, they've been sending you a distribution every quarter, and in 3 or 4 or 5 years later, they sell the property and send you your principal back, hopefully with some gains. That's what a syndication is. Okay, and they usually split up the money. Okay. Typically, you'll get all your principal back first. That's the first priority. And then you'll get a preferred return. That might be 6% or 8%, but basically you get that before you start splitting any additional returns with the operator or the manager, the general partner, if you will. You're the limited partner, you're the investor. And so above and beyond whatever the preferred return is of 6 or 8%, you split returns in some way. Maybe that's an 80-20 split, or maybe it's a 50-50 split. Just depends on the individual syndication deal. But that's what a syndication is. The downside of investing in syndications, aside from the fact that it's an illiquid investment for like 5 years, is some syndicators aren't that experienced. They're not that experienced. Maybe they use a little bit too much leverage. Maybe they use adjustable rate leverage, and 2022 happens, and all of a sudden they're like, we need more money to operate this place so we can get it to where we can sell it, and they start doing capital calls to you. Okay, those are some of the downsides. The other downsides is the minimum investment tends to be high. It might be $50,000 or $100,000 or even more. And so in order to diversify a portfolio of syndications like this, you got to be fairly wealthy. Let's say you want at least 5 of them, maybe. Well, if they're $100,000 a piece, that's $500,000. And if you're only putting 25% of your portfolio into real estate, well, you've got to now have a $2 million portfolio before you can really diversify these investments. So these maybe aren't the investments to use your first year out of residency, right? But if this is something you're interested in doing, it is something you can do down the road. One of the easiest ways to do it is to use a fund. This is mostly what we invest in when it comes to private real estate. So for your $100,000, instead of getting one apartment building, you get 15 of them, right? Or parts of 15 of them. And so you got quite a bit more diversification there. If one of them goes bad, the manager can mail in the keys. And that has happened in one of the funds I own. They can mail in the keys and you still get a reasonable return, right? That fund, I think, had 10 or 12 properties in it. They mailed in the keys on one of them. We still made 10% a year on the investment. So it wasn't some terrible catastrophic outcome, but be aware that that sort of a thing is a risk when you're using leverage to invest. Hope that's helpful.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.